AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today.
We're here every Thursday, 6 to 7. Drive time special, I like to say.
For you who are hearing us for the first time, we've been on the air for quite a while. This is our 7th year.
Time is clocking.
Time is clocking. You can always call the show. It is a live show. 800-516-1220, 800-516-1220, or email the show, info@bayarealoansource.com, info@bayarealoansource.com. And you can send us your questions, get your comments on the air. We also have a Facebook page. It's called the Real Estate Report Radio Show. You can always join us there. We put we do some live Facebook Lives after the show. Those are always fun. Some of the stories we're going to hit today, more homeowners are saying that it's a good time to sell. We're going to get your intake on that, Gordon, because I know what you're going to say. Amazon, could they be creating the next boom in some U.S. city? This is a really interesting article. I don't know if you saw it yet, Gordon. Co-borrowing is on the rise. We kind of knew about this, but what do you need to know about co-borrowing when you get involved? We're in the lending business and the real estate business, but when we run across people who are co-borrowing, and this is not I'm not talking about married couples. I'm talking about people who are not married, and that's on the rise. How to get rid of private mortgage insurance. I think we're going to touch base on this again. A lot of equities have gone up. A lot of people did get mortgage insurance. How to get out of that. Foreign buyers in the United States hits a new high. It's kind of a little news tidbit. Housing demand drops according to Redfin. And probably the news of the day, Gordon, Equifax just got hit with one of the largest thefts of private or personal information next to Yahoo. They just lost 143 million pieces of information, including social security numbers, dates of birth, addresses, and in some case, driver's license. And this sensitive information can be enough for crooks to hijack the identities of people whose credentials were stolen through their own fault or faults of their own, potentially wreaking havoc on victims' lives. So let's start with this story, Gordon. How important is this for people to know if their information was stolen? There is a website you can go to find out if you were part of that theft. It's EquifaxSecurity2017.com. I'd highly recommend people go out and find out if they've had their information stolen.
Well, fortunately, I hope none of our listeners have identity theft. Identity theft is a very, very serious issue. It takes a lot of time. It takes a lot of energy just trying to get this stuff cleaned up. All kinds of things happen to you when you have identity theft, especially in today's world where credit is everything. As we talk on the show many times, when people go looking for a job, they run your credit. You go to rent a car, it looks like they run your credit. Everything you do is credit driven. That's why the security of these online services, you got to be really, really, really careful on what you apply for and the information you actually put out there. Actually, I was just reading an article the other day that they were saying that posting your cell phone numbers is not really a good thing. It seems like thieves are finding ways how to encrypt your telephone number, getting access to your information. So in today's high-tech world, anything is possible.
Yeah, I highly recommend that you check your credit. Places like Credit Karma or apps like Credit Karma is a useful tool to see if somebody else is using your credit, but you can always go and have some security alerts put on your credit report. For example, you can use your phone number, so if somebody does access your credit, they call you first. All right, so when you go and let's say you buy a car and they run your credit, you'll be sitting there in front of the guy and you'll get a phone call saying, hey, this is so-and-so, Equifax or Experian or whoever, somebody's running our credit. Is this you? And they'll ask you some identifying numbers and questions. That's something that I would highly consider. This is a day and age where everything's digital, and you have a personal identification footprint, and you got to protect that just as much as you protect your wallet. And indeed, it's like your wallet. So 143 million Americans could be affected by this high-tech heist is what they're calling it. So again, the website is EquifaxSecurity2017.com, or you can email us, Tony@BayAreaLoanSource.com. I put that out again. Interest rates continue to be the other kind of story that's out there, and they've been dropping, Gordon.
Interest rates are low, very low.
Going back to July 13th, I believe, they've been going down every week except for 1 week. They've been going down. 3.78 is 30-year fixed right now, according to Freddie Mac Weekly Survey. 15-year at 3.08 and the 5-year ARM at 3.15. All great rates. They're yearly lows right now, back to November 2016 levels in the yields for the bond, and that creates lower interest rates. They spiked over about a half a point back in November, and they've been coming back since. In North Korea, they're again in the headlines with a little help from a couple hurricanes that are coming, pushing investors into safe assets, or what they call flight to safety. And we've also had a sideways pattern, Gordon, where a lot of investors' perceptions of Trump's fiscal policies, they're looking for more signs of that living up to its expectations. And so we've seen a lot of people go into these safer assets until these things get figured out, including the Fed. We're also watching the Fed. So everything's kind of toning down a little bit until things come to fruition.
Yeah, it looks like Mr. Trump has settled in office. A lot of turbulence. I think there's going to be turbulence with him based on his personality for his entire term. So I think we just have to learn how to stop reacting to that's his character, that's who he is, and just kind of look at the information that he puts out there that's going to kind of generate or move the market in one direction or the other. A lot of people are bullish on Trump as far as business people are concerned. People are still waiting they still believe that he's going to get a tax cut for the country before the end of his term. So I think a lot of people actually that does not agree with his policies are bullish on him because they feel that they're going to be more profitable in a Trump-led economy.
Well, we all know that interest rates, when we have low interest rates like this, it opens up opportunities for people to kind of manage their debt. You just got off the phone with a client who's like, they have $400,000 loan. They have unbelievably over $150,000 in debt. And I'm talking revolving and installment debt, credit cards, car payments, student loans, things like that. And they have a second loan that's coming up that's going to reset soon. And when you have low interest rates like this, it gives these people opportunities to lower their bills. Number one, for every dollar that you take out of a credit card and put in a mortgage, it's about 30 cents. So they can save money there, and then they can also hedge against that higher rate that's going to come on that reset for their second.
And that's what we always talk about, these equity line seconds that are so easy to get. They're very, very popular now in the marketplace, led by the big banks that are actually pushing these things back onto the public. They're interest-only payments. They're fixed over a period of 10 years. After 10 years, typically most of them reset. They go to a fixed rate payment, either 15-year fully amortized schedule or a 20-year fully amortized schedule. So their payments right now about $771 interest only on a little over $200,000 in debt. That loan is going to technically reset February of 2018. That payment's probably going to go up 3 times. They're going to have a really hard time affording that payment if they don't get out of it now.
Easy in, hard to get out.
Absolutely.
That's what those equity lines are sometimes. And not only that, we've seen people where they just, in this case, it sounds like they ran up some of the equity line and then they ran up credit cards. So all thinking that because they do, and they have a beautiful house in Mountain View.
Mountain View, and they have great credit. So there's a formula there for them. We just have to figure it out for them.
Yeah, but it also gave them a little false sense of security that they continue running up that debt, whether it's in the equity line or in the credit cards. And now they got to figure out how to get out of it. And again, the whole story is that low rates offer these opportunities. Refinance applications have spiked. They're about 6% in 1 week. And I expect a lot of people looking to lock in some good opportunities. We're always welcome to run scenarios. You can always email me at Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. But easy in, easy out. Be careful of those equity lines, especially when there's low rates. Because for those people who don't know, you can get a cash out refinance cheaper, in rate, than you can an equity line right now. So
right, but the problem, the equity line, the payment is based on interest only, so some people get lured in with the false equity that payment's going to stay low forever. Some of these payments on $100,000, like $117 a month, and people just get sucked into that, and that's how they kind of get tied into that equity line, which is a consumer loan, not actually a real estate loan, and there are repercussions if something does go sour on that deal.
You can always call the show 800-516-1220, 800-516-1220. Email the show info@BayAreaLoanSource.com. More homeowners are saying it's a good time to sell. Instantly, I think, Gordon, that it's, is this starting to pan out as some sort of peak? It's really not, because even though the numbers are pretty large, 36%, the spread between those who think it's a good time to sell, and those who don't think it's a good time to sell, the spread is about 36% right now. Okay, so it's not really as far as you think, but more and more people think that it's the right time to sell.
Yeah, I get a lot of questions. People call or email us, hey, Gordon, values are up. My neighbor just sold his house for some unbelievable number. I'm considering selling. And the question I always ask is, okay, where are you going to move to? Where are you going to take that equity to? And that's the challenge. If you can't, it's hard to scale down in our market unless you're going to leave the state and move to one of the more cheaper states to live in. It's very, very difficult to sell, stay here, and maintain the same standard of living in our area because of where values have gone on the lower ends.
I think that's a perfect segue into this email that we got from Jim. And Jim is trying to sell his house and buy a new one, but he needs the equity from that house. He doesn't have any other money. All his other money's tied up in retirement, and he needs that equity to buy the new house. But his realtor is saying, well, you got to sell your house first because we can't offer a house on this new house with a contingent sale. Contingent sale is when you tell the new seller that, oh, I got to sell my house first before I can actually close on yours. That's such a turnoff to sellers and the listing agents who are advising their sellers not to take offers like that, which I'm going to stay out of that argument for the moment, which if their house is selling so fast, why can't the other house sell so fast? So I have a little bit of problem with that, but Jim wants to know if there's things called bridge loans because people want to take that equity and they want to find another house in a different part of town or different part of the city or county, better schools or so on. It could be upsizing or downsizing. In this case, Jim's downsizing, as he says, but he can't get the equity out. So he has to sell first, go into temporary housing, and then move to the house afterwards. It's almost like two transactions.
Yeah, I mean, nobody wants to move twice. When we talked about the scenario earlier, I recommend that he talk to the agent and see if they can do a 30-day rent back. And you can still do a contingent sale, but do a 30-day rent back. That way it gives him the extra time to sell his house without having to sell his house and move into something else. So I think in the competitive market we're in right now, I think there's enough room and there's enough information out there where the seller can look at the house, see what kind of condition the house is. Is that house going to sell if they wanted to accept a contingent contract?
Here's what's crazy about that is he also puts in his email. It's a very long email. He also said that the reason why he can't do the rent back because that was something he suggested to his realtor is because the realtor said, number one, you have to do a lot of work to your house and you're going to want to move. And number two, they're going to stage it and we don't want you in here. So it sounds like the realtor is saying this is the way the market is in this city and we're going to recommend you leave, whether you go buy a house right away with some other money or you go to temporary housing. So
I think you should get another realtor's opinion.
There are some options here, all right, because I promised a lot of people that we would talk about this. You can always refinance or get an equity line to take some cash on your current house before you sell it, okay, and then you can use that money and get what they call a low down payment loan. Let's say you can only get $100,000 out of it. Oh, you know what? I think we're going to have to come back and talk about this after the break, but I did promise a lot of people we'd talk about this. We want to talk about this Amazon story. Amazon is thinking about putting up another big office in a U.S. city, and and I think that city is already identified. We're going to talk about that when we come back. All those investors that want to know about that. Here on AM 1220 KDOW, I'm Tony Mendez. That's Gordon Hines. You can always call the show 800-516-1220 or email Tony@BayAreaLoanSource.com.
343. This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
So we're officially on producer number 4. And I gave him free reign of music tonight, just kind of feel out what kind of music he's going to play. So far, so good, Marco.
Welcome, Marco.
I thought Polo was supposed to be next, but I
said
that earlier, too.
I started to say that, but I didn't because I knew you
Good job, Marco.
That's why I didn't say it.
Good job, Marco.
He's not listening.
There we go. Okay, so we were talking about an email that we got from Jim. Jim's trying to sell his house and buy a new house. He's got a ton of equity in that house, but he wants to move it over, but he doesn't qualify
for 2 mortgages.
For 2 more. Well, that's something else that we want to talk about. He just doesn't have the down payment for the new house. He needs to get it out of his house. So his realtor is telling him that he needs to sell his house first because we want to stage it. We want to do some repairs, get top dollar for it, and you need to move out. You need to move all your stuff out, move you out, temporary housing, sell your house, get the money, move to the next house. 2 transactions, not an easy transition for him. But there are some ways if you do have a little bit more planning. maybe refinance your house, take some cash out, and put that aside so that you can use it, and then do what they call a departing property rule, where you depart the property, you turn it into a rental, on paper that is, and you are going to tell the lender you're going to rent it out. They use market rents, right? And it offsets the debt, and then you buy the new place, and then when you're done, you sell it. But then you still have to go back and bring more of the equity over, because remember, you can only borrow so much money. And if you need all that equity, that means that you have a kind of not a risky, but a shorter term loan on the new house. So you may be doing 3 transactions. You may do the refi to get the cash out. You may be buying the house with the low down payment. Then you sell the house, and then you do another refi. So there's 3 transactions. It might actually make sense for this person to move out, right? Pay short-term housing, right? Because he's going to be housing somewhere, right? Whether it's in a home loan or at some sort of extended stay place, he's going to be paying a monthly payment. It's going to be a lot cheaper than doing 3 transactions, right, Gordon?
Yeah, I mean, I always tell things, these kind of situations, the great thing about this situation to me, you got options. Anytime you got options, you're actually in the driver's seat. I mean, like we said, he can, if they can't renegotiate an extended stay and a rent back, he can always take a private loan. We can always give him I can give him a $500,000 private loan tomorrow to go behind his purse, and he can use that $500,000 cash to use as the down payment. So he does have options, and there are many different options. Every option is different for every specific buyer. I don't know what his tolerance is as far as carrying the debt, so we'll have to sit down and match him to which option works best for him.
Well, I imagine his tolerance would have to be pretty high to do that. I mean, some people might be that way. They might have a family, and they may not want to. They may not be able to go to extending stay. But it is an option. So that would be the second option. Another one, possibly getting some gift money and then paying it back once you're done.
You can borrow some money from a relative.
Get some money from relatives. You see my house. Here's the appraisal. I owe. I have several $100,000 in equity. I'll pay you back when I'm done. And then possibly borrow from the retirement. But there are low down payment programs for people that can do this, and what we call short-term financing, whether it's a private loan or a portfolio loan with decent rates. You can even get interest only on some of these portfolio loans to minimize your costs, and then you refinance out of it once you sell your other house. So some of those things are options. You're welcome to shoot us an email about your scenario if you have something like that and want to discuss it. Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. I want to talk. I love this Amazon story, Gordon. Amazon is, and let me see if I can find it. Amazon is they're looking for a city somewhere in the United States where it can site a second headquarters that would just be as big as the one they have in Seattle. They said this today. And Austin, Texas is on the list because they already have a facility there. And they may just they're looking for about, I think, 100 acres, something like that. And they're going to plan on doing this build out about 2027. But my gosh, Gordon, if you were to move, I mean, Amazon can control the fate of any city that it moves to. When you're putting, how many employees they say here? 380,000 employees worldwide. Oh, they want to do 40,000 employees in this building.
That sounds to me like an NFL team, where they are looking for cities to leverage out for them to get a free tax base, where they're putting an article out there they're looking to move.
Reno's been doing this forever.
There's plenty of cities to move to if they're really looking to move.
But the average annual salary for it's 50,000 employees that are going to work at this new facility, $100,000.
Yeah, but they also got to go into cities that have skilled labor. You don't want to go into downtown Beaufort, Oklahoma. So it's a lot of things they have to look at. Sometimes you got to look at the dynamics of the city. A lot of these cities, like I've read an article in Ohio don't have enough skilled labor for some of these plants that are building. So they're now trying to retrain employees. So there's a whole lot of things go into the mapping out of where you're going to put your company. A major company like Amazon, is great. So we'll see how it turns out.
If it means anything, Austin is number 3 on the list of where people are moving to in the United States. Number 3 with a 10.45% net migration from 2011 to 2015. That's up 10.45%. So Austin is kicking butt right now. With that said, we'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. You can always go to our website, BayAreaLoanSource.com, if you miss any of our content.
This is Money 2.0 on AM 1220 KDOW.
Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can always call the show 800-516-1220, 800-516-1220. And if you want to get our podcast, you can always go to our website, bayarealoansource.com, or join our email list. You can go to the same website, bayarealoansource.com, and we send out links to that as well. Victims of Hurricane Harvey have spoken out after landlords demanded rent from their flooded uninhabitable homes. This was an interesting article. They're saying that the landlords are making them pay rent and late fees every day that they're gone. Texas Property Code states that if the property is totally unusable due to a disaster, then either the landlord or the tenant can terminate the lease through rent notice. However, if the property is deemed partially unusable because of a disaster, a tenant may only get reduction in rent determined by a county or district court. Interesting stuff. But I think what this story talks about, and it is unfortunate that there's another hurricane coming, and a lot of people are like, we just watched, a whole bunch of Texas residents, like 30% of them had flood insurance. Because it's wind damage is covered, but not the flood damage. And Gordon, I know this is this hits home for you because I know you recently had a flood in your basement, and most people who get a flood aren't prepared for it, and it's something that can really mess up your life.
Yeah, when we hear the term flood, most people think streets overflooded with water. Water coming up from the ground is considered to be a flood. I just recently learned that. Last storm we had in the wintertime, I live on a hillside, water is coming down the hill underneath the foundation and pouring into the downstairs of the home. Called the insurance company. They said, well, that's not covered through your regular insurance. That's actually flood insurance. I didn't know that. So I think anytime there's a disaster is a great time for you to call your agent or just kind of review the limits and what your policy will and won't pay for. Flood insurance it's very inexpensive, but I ended up buying a flood insurance policy just in case it happens during the next winter. But it's not that expensive. But when people think flood, they always think about, river streams overflowing, but actually flood can come from what they call groundwater.
And rain.
FEMA flood insurance is you can always check to see if your property, you don't have to be in a flood zone to buy flood insurance. Anybody can buy flood insurance. So it's actually a good thing to actually look into. It's actually a great thing right now with all these natural disasters happens to take some time and to review your policy.
It's all about awareness. And it's not just whether or not you need flood insurance or you think you would, is your homeowner's policy, your hazard insurance, because how often, Gordon, have you run across somebody who hasn't refinanced in a while? They refinance and the lender goes, these people don't have enough coverage for their replacement costs in their house. And that's the last thing you want to do is find out that your insurance isn't covering the replacement cost on your house.
Yeah, we do a lot of different things with insurance. We have the other thing that we always run into, people buy a house. We always talk about it's great to own more than one property. They buy a house, they move from it, they buy another house, they turn the house into rental. They never really convert the old homeowner's policy to a rental policy. There's a claim, and then it's not covered because it was called by a tenant, and the insurance company didn't know the property was tenant occupied. It's always really good to make friends with your insurance agent. Have that person, earn their keep. Have them review your policy, tell you the do's and the don'ts, what to do, what not to do, and you can get better policy coverages. You can get better rates on policies if you have a good insurance agent.
And I like the bundles as well. We just recently bought a house and we bundled everything together. And I was like, oh, okay, that's cheaper than the other house, which we have insurance on it from something else. But So the bundles are always good, but it's always important. It's just part of the things that you do on a regular basis when you own a house.
You have
to clean the gutters.
Yeah.
You paint the house, you replace rotten wood, and you review your insurance.
And you talk to your insurance agent.
Yeah, and you do those things. A lot of people, I want to talk about this as well, Gordon, mortgage insurance. Homes prices were rising. Let's go back to 2010, 11, 12, 13, 14. Home prices rising. A lot of lenders were loosening up their guidelines. Mortgage insurance was becoming more popular. And not only that, home prices were lower, which means loan amounts were lower. And a lot of people got FHA loans. So a lot of people have mortgage insurance. So we want to talk about how to get out of your mortgage insurance when we come back after this break. If you have a call, 800-516-1220, 800-516-1220. You can email the show, Tony@BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com.
We'll be right back.
And we'll be right back here on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Going back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Always call the show 800-516-1220. 800-516-1220 gets your calls on the air. Any mortgage questions, any real estate questions, any questions that you want answered. We'll screen them, of course, if it's not real estate related. How to get rid of private mortgage insurance. Well, you can always refinance. You know, there's one misconception that a lot of people had when they got mortgage insurance, and that is, when I have an equity of 78% or 22%, which means your loan to value is 78%, my insurance will drop off. Well, that's not true. It's when your balance is 78% of the original appraised value. So you could have gone up, $200,000 or $300,000 in equity, or 20-30%, but it's your loan amount compared to your original value. So the only way, so it won't drop off, but you can refinance out of it. The second way to do it, and we're starting to hear more and more lenders, and I know you've heard about this, Gordon, where lenders are now saying, send me an appraisal. So go out and spend $200, $300, or $400, $500, $600 on an appraisal, and they might use the current value and see if it'll drop it off. Have you heard any success stories about that?
Yeah, I've had a client that did the same thing. They had bought a house, had a great deal in the house, of course, didn't have enough to put down, was forced to get mortgage insurance, and then about a year later, they wanted to drop the mortgage insurance. They were able to, the lender was kind enough to let them get an appraisal. They had two appraisals, actually. The lender picked one and they picked one. They used the average of two, and they were able to get rid of the mortgage insurance that way. But we don't see that a lot now. The best way to do it is kind of refinance out of it. You can take cash out. There are options out there. You might be able to get a lower rate. There are a lot of people that are in FHA loans because that was the only loan that was available to them after they came out of the crisis a few years ago, because the waiting periods of foreclosures and short sales and deed in lieu's were much longer than they thought, even they were putting down more than 10% or 3%, whatever the case may be, and still had to take mortgage insurance. So those are the people that we're very, very interested in helping, because they can either get out their mortgage insurance and save that money on a monthly basis.
So mortgage insurance is and can be pretty high in some cases, especially as you have a higher loan amount. I mean, some loan amounts for FHA were as high as $725,000, $729,000, right? Yeah. And imagine 0.1% of that divided by 12 comes out to, let's just say it's $700 a month. And yeah, your rate might go up because FHA has really good rates, but you lose the mortgage insurance, so you might save $500 or $600 a month. Absolutely. So it really does make sense, and it's worth looking into it. Some of the other requirements to cancel private mortgage insurance, according to the Consumer Financial Protection Bureau, the CFPB, you have to request the PMI cancellation in writing. You have to be current on your payments and have other good payment history. Read the fine print. This stuff is in there when you get the mortgage insurance. You might have to prove that you don't have any other liens on your house, and you might have to get an appraisal to demonstrate that your loan balance isn't more than 80% of the home's value, or 78%. So there are some things you have to do. They are required to the lender. That is required to tell you what they expect your timeline to be for it to drop off. And I think you should at least contact it. But also, we can help with valuations. We do this all the time. What's the valuation? What's the new loan amount? How much will you save by dropping off the mortgage insurance at current rates? And this is something we do all the time. This is why we do the show. This is so we can encourage people to at least explore these options.
Yeah, and if all those fail, then refinance, and that we can start over with a new lender, which you won't be held to those same requirements. One thing, Tony, HARP was a very popular process a few years ago. Fannie Mae and Freddie Mac HARP actually ends at the end of this year, September. I saw something there that we're looking to extend it through the end of the year, but as of right now, HARP is supposed to end at the end of September 30th, 2017.
Home Affordable Refinance Program was very useful when property values were lower. For example, you can refinance your house if you owed $200,000, but the property value was only $150,000. For example, that was the use of HARP, and it's almost an automatic qualification for that.
The only thing you had to be was current on the mortgage for the last 12 months. There was no appraisal required, and they didn't get any income documentation. As long as there was a financial benefit, as long as you were in a Fannie Mae, Freddie Mac loan taken out, I think between 2006 and 2009, you were eligible.
Yeah, it has to be a Fannie Mae. We ran into a lot of people who needed this type of product. Otherwise, they were going to that other lender-sponsored one called, I can't remember what it was called, but it was a lender-sponsored program. I think about 18 of the largest lenders in the United States got together and said, oh, yeah, we'll go ahead and help you do the. And it's kind of like a loan modification program, but they were also telling people that they needed to go late on their payments before they would assist them, which I think it should be illegal. A lot of people we run into, oh yeah, we have a
Mortgage
a
late.
modification, but we weren't current on the mortgages. I'm sorry, on the payments leading up to this modification, because they wouldn't do it. They wouldn't touch it unless we were late. And then that same lender, 2 or 3 years later, puts on a guideline that says, "Oh, we can't refinance you if you have a modification if you were late on your payments leading up to the modification." So they backtracked and they backstabbed everybody for the most part. So I think that was completely illegal.
Yeah, there were a lot of bad information, I think, during that period of time. I mean, so much went wrong, and so much went wrong even more trying to fix it right. And lenders, of course, some of the big lenders that were leading the charge, as one of our favorite lenders seem to be in the news every week is Wells Fargo. Negative news. I don't know what's going on with that company, but I got an article here. They're settling about Wells Fargo about to settle $142 million settlement. I don't know what his shareholders going to say about all these settlements that Wells Fargo has been settling lately.
Yeah, and that's just one lender. Do you remember the Implodometer?
No, I don't.
The Implodometer was it was a website but to inform people what lenders were going out of business, and we always got a kick out of it. We never saw any of the big ones, but they all got bailed out. With that said, we got a couple more stories to hit. I definitely promised some people.
Well, you mentioned earlier
co-borrowers.
One of the things you mentioned earlier was you're talking about foreign investors that were flocking to the United States as far as that National Association report was concerned. And Chinese borrowers were the top foreign investor in our U.S. home sales economy.
Foreign buyers and recent immigrants bought $153 billion of residential property over on a year-to-year basis back in March. Canadian interest jumped up significantly. Chinese investors did their $3.1 billion. That's up from $27 billion. The top 5 countries in terms of sales dollars: China, Canada, the UK, Mexico, and India, all saw increases from last year's levels. They're buying in Florida 22%, California 12%, Texas 12%, New Jersey and Arizona round up the top 5. Florida is the favorite spot for Canadians, and California, Chinese and Mexican buyers.
Yeah, that's confidence in our economy.
It is.
It's a good sign.
And it's going to continue growing like that, especially with low interest rates and the rules. I mean, foreign nationals can buy properties here in the United States, get loans, which is crazy. We'll come back after this break here on AM 1220. You can always email the show, Tony@BayAreaLoanSource.com, or call it 800-516-1220.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
We are here. We are live. 800-516-1220, 800-516-1220, and we're keep on plugging away here. Co-borrowing is on the rise. Total mortgage originations increased in the second quarter. However, borrowers are increasingly relying on the help of a co-borrower. The report found this is by Atom Data Solutions, ATTOM, fantastic real estate data source. They reported that 22.8% of all purchase originations on single-family homes involved a co-borrower, not married borrowers. This is up 21% from the previous quarter and 20% from last year. What do you think that means, Gordon, that we're seeing more and more co-borrowers?
Well, that means one thing. Many people across the country are listening to our show. I didn't realize we were nationwide. That's one of the things that we preach on the show is in a tight market such as this, it's a great idea to team up with someone to buy a property. You don't have to be related as long as it's a common interest, which is be homeowners, get a tax write-off and own a piece of rock. So it looks like people are actually doing it. It's a great idea. I'm bullish on any type of activity that's going to land people to be homeowners. I'm all for. There was a client yesterday where we were just talking about the same thing. She's looking at scaling down. She's looking at buying a duplex for her son, the 1 bedroom for her, the 2 bedroom for him. If he or she decides to move out, one person can still live in the property and own the asset, while the other move on to something else. So I'm a fan of that.
Among the top 42 cities with at least 1,500 purchases of single-family houses, San Jose topped the list with 50.9% of buyers had co-borrower. So it's very popular.
And San Jose is one of the priciest market in the country. So there you have it.
Some of the things you want to know about when you use a co-borrower is you're also commingling your debt. You're not actually running a credit report together, but you are adding your debt together so to calculate the debt ratios, but you also get to add your incomes together when you qualify on the same home loan. But when that does happen, and let's say 2 or 3 years down the road, that person wants to move out, maybe sell their portion. Can you do it? You may have to sell the house. But what we see a lot is somebody else that co-signed, and maybe it's just a parent that's co-signing for someone, and the person who bought the house destroyed the credit of the co-borrower. And that's the really tricky part, is that you are attached to that other person's ability to make those payments. So
yeah, the debt is joint, what we call joint and several, meaning that you can't pay half and say, well, I paid my half and he didn't pay his half, or vice versa. You're responsible. Both parties are 3 or 4 parties. It's not limited to one party. It could be 3, 4, 5, 6 parties are all responsible for the full amount of the debt. One of the things that I do recommend, if you are going to buy a property with someone, I don't care who it is, if it's not a spouse, it's always to have what we call a buy-sell agreement. What would happen in X amount of time if one person wants to buy or be bought out, how much time the other person is going to get, what the equity position share is going to be. So it's always good to have an agreement, because everything is good until it goes bad.
Well said. And that's the nature of real estate sometimes. And what do they say about real estate? If you want to lose a friend, buy real estate with them?
Buy real estate with them.
Yeah, it's unfortunate, but that can cause a lot of headache. So you want to do a lot of preparation in advance. But even though when you do commingle that credit, you can always absolve yourself from the debt. For example, if it is a parent and the parent wants to refinance and they're tied to this other debt, you can always show 12 months of payment. So usually you're tied to that for about 12 months. There's a lot more to know about doing co-borrowers and that kind of scenario. You're always welcome to shoot us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. I want to make sure that we mention the seminar that's coming up this weekend. It's a Rob Black seminar, Rob Black and Your Money. It's a retirement income strategies and estate planning seminar. You can register at robblack.com. It's in San Rafael, September 9th, which is Saturday, 10 a.m. to noon at the 4 Point Sheraton. Fantastic seminar. I will be there. Again, you go to robblack.com to sign up. And I think he has a promo code. I think it's Radio23. But you can always email me, Tony@BayAreaLoanSource.com, if you need that code. Again, that's Tony Mendez, Tony@BayAreaLoanSource.com. We'll come back next week. I'm Tony Mendez.
And I'm Gordon Hines.
And this is the Real Estate Report. We'll be back next week.